Welcome to the Money RX for CRNAs podcast. I'm Brett Fellows. So here's a question that might surprise you. What if I told you the government has a legal way to tax the same dollar twice? You probably think that sounds impossible, but it happens to thousands of people every single year through something most have never heard of called provisional income. You see, most CRNAs assume Social Security is tax-free. After all, you've been paying Social Security taxes on every paycheck for 30 years. The money going into the system was already taxed. So the money coming out should be tax-free, right? Wrong. Not only can Social Security be taxed, but for most CRNAs with decent retirement savings, up to 85% of your Social Security benefits will become taxable income. And the kicker, the income thresholds that trigger this taxation were set in 1984 and have never been adjusted for inflation. So what qualified as high income 40 years ago is now middle-class retirement income. Which means if you're planning a comfortable retirement on your CRNA savings, you're walking straight into what I call the Social Security tax tsunami. So today, we're going to show you how to avoid this problem. Because understanding this one issue could save you tens of thousands of dollars every year in retirement. As I said before, for most CRNAs, Social Security will be taxed. In fact, if you're married and your household income exceeds $44,000 in retirement, up to 85% of your Social Security benefits become taxable income. Let me put this in perspective. The average CRNA Social Security benefit is around $2,800 per month. That's $33,600 per year. If 85% of that becomes taxable, you're looking at $28,560 of additional taxable income every year. But most CRNAs don't just have Social Security. You have 403B, 401k accounts, maybe some pension income, maybe rental properties. Add it all up, and you're often looking at total retirement income of $80,000, $100,000 or more. This is where the tax tsunami starts. Social Security taxation works on what's called provisional income. Now, this isn't your regular taxable income. It's a special calculation that includes half of your Social Security benefits, all your other taxable income, and tax-free interest from any municipal bonds. Once your provisional income hits certain thresholds, your Social Security gets taxed. Now, for married couples filing jointly, the first threshold is $32,000. Once your provisional income exceeds $32,000, up to 50% of your Social Security becomes taxable. The second threshold is $44,000. Once your provisional income exceeds $44,000, up to 85% of your Social Security becomes taxable. And for single filers, the numbers are $25,000 and $34,000. Now, as I mentioned, these thresholds were set in 1984, and they've never, ever been adjusted for inflation. So what seemed like high income 40 years ago is middle-class retirement income today. Let me show you how this works in practice. Take Mike and Sarah, both CRNAs. Their combined Social Security is $5,000 per month. They need another $3,000 monthly from their 403B account to cover expenses. So their provisional income calculation, half of Social Security is $30,000, 403B withdrawals is $36,000. So total provisional income is $66,000. Since they're well above the $44,000 threshold, 85% of their Social Security benefit becomes taxable. That adds $25,500 to their taxable income. So their total taxable income becomes $61,500, and they're paying taxes on money they thought would be tax-free. So I see three big mistakes that many people make when it comes to Social Security. The first and probably biggest mistake I see CRNAs make is claiming Social Security early at age 62 without understanding the tax consequences. When you claim Social Security early, you not only lock in a permanently reduced benefit, but worse, if you're still working or taking large retirement account distributions, you can trigger massive tax bills. If you claim at 62 while still working part-time and taking 403(b) distributions, your provisional income can skyrocket. You can go from the 12% tax bracket to the 24% bracket overnight. So the solution: delay Social Security if possible and use those early retirement years for tax planning. This is your golden window for Roth conversions and tax-free growth. Okay, the second big mistake I see is ignoring the Medicare premium penalty. Social Security taxation doesn't just affect your income taxes. It affects your Medicare premiums too. Medicare uses something called IRMAA, Income Related Monthly Adjustment Amount. If your modified adjusted gross income exceeds certain thresholds, you pay higher Medicare premiums. And for 2025, those thresholds start at $106,000 for single filers and $212,000 for married couples. The extra cost can range from about $74 to over $444 per month on top of your standard premium per person. CRNA couple Jim and Lisa learned this the hard way. Their Social Security taxation pushed their income over the IRMAA threshold. They're now paying an extra $8,000 per year in Medicare premiums, money that they never budgeted for. The third mistake has to do with required minimum distributions, or RMDs. At age 73, your required minimum distributions kick in. Now, for CRNAs with large 403(b) balances, these can be substantial. A CRNA with $1 million, let's say, in their 403(b) faces required distributions of about $37,000 at age 73. Add Social Security and other income, and you're often pushed into higher tax brackets while triggering more Social Security taxation. And this is the double whammy. You're forced to take distributions you don't need, which increases your taxes and makes more of your Social Security taxable. The key is planning for this years in advance through strategic Roth conversions during your early retirement years. All right, we've talked enough about mistakes and the problem. What about the solution? The solution is really just strategic tax planning. And the first strategy is to control your tax brackets. Use your early retirement years to manage taxable income. Fill up lower tax brackets with Roth conversions. Take advantage of the standard deduction. The second strategy is asset location planning. You want to keep tax inefficient investments in Roth accounts. Use taxable accounts for tax efficient investments, because this gives you more control over when you recognize taxable income. And the third strategy, Social Security timing. For many CRNAs, delaying Social Security until full retirement age or beyond makes sense. Not just for the higher benefit, but for the tax planning flexibility. And the fourth strategy, create tax-free income streams. Build up Roth accounts and taxable accounts that can generate tax-free or tax-efficient income without pushing you over the Social Security taxation thresholds. Let me give you some real numbers to show you how much this matters. Take two identical CRNA couples. Same savings, same expenses, same Social Security benefits. Couple A claims Social Security at 62 and takes large 403b distributions. Couple B delays Social Security until 67 and uses their taxable accounts first. Over 30 years of retirement, Couple A pays approximately $180,000 more in taxes. Couple A has $240,000 less wealth at age 90. So Couple B maintains financial flexibility and leaves a larger legacy. So the difference comes down to understanding how Social Security taxation works and planning around it. So what are your next steps? Social Security tax planning isn't something you figure out at retirement. It starts years before. So if you're within 10 years of retirement, you need to start modeling different scenarios. What if you claim Social Security at 62 versus 67? How do different withdrawal strategies affect your overall tax bill? Now, if you're already retired and caught in the Social Security tax trap, it's not too late. You can still optimize your withdrawal strategies and potentially reduce future tax bills. The key is working with someone who understands how all these pieces fit together. Social Security, retirement accounts, tax brackets, Medicare premiums. It's all connected. Because the biggest mistake isn't just paying extra taxes on your Social Security. It's realizing you have options to avoid it. Thanks for listening to Money RX for CRNAs. If this episode helped you understand Social Security taxation better, please share it with another CRNA who could benefit. And if you're ready to create a comprehensive retirement plan that addresses Social Security optimization, tax planning, and wealth preservation, visit our website to schedule a consultation. Until next time, this is Brett Fellows reminding you that personal finance should be personal.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.